So I'll actually pull this guy down. So, yeah, oh yeah, that wasn't me. So if we want to go with kind of a simple overview, I tend to draw this out for a lot of clients when we get to our first meeting, kind of getting a sense of what does financial planning really mean. I invite you to draw it too, because it's more interactive that way. But so I kind of like the idea of financial planning starting from a strong foundation and building your way up towards where you want to go. And prioritizing the things that you want to prioritize or should prioritize as opposed to things that are just easy to prioritize. So where do you think the source of money is going to come from once y'all are done at Stanford? Where are the dollars that you have to work with going to come from, like we talked about over on that side? Primarily. Simple answer, I swear. Job. Yes, correct. 1 for 1. So your income or your job is number 1. Making sure you solve for the money coming in so it can be greater than the money going out. That's the first one. There is a bit of risk management that I put on this one as well. This is where benefits, my parents always asked me this when I was graduating, oh, did you get a job offer with benefits? And I just kind of said yes, I had no idea what that meant. But it's, do you have health insurance included, disability insurance, life insurance, things like that. Health and disability insurance are the ones that matter for you, because you're still here. Those are the things that make sure that you can still keep the income greater than the expenses, right? So starting with knowing what you have to work with, and then building your emergency reserves. So Chris talked about this. If I'm going to pay down that student debt really aggressively, I can't get that money back if I need it for something that comes up that's unexpected. So building an emergency cushion in cash, even though that cash is going to not earn the same rate of return as the debt over here, you still got to have the cash. Because once you pay down that student loan, they're not going to give it back to you again. You'd have to start putting it on a credit card or other higher interest debt probably. Does that kind of make sense? So you have to kind of, it's part of the cost of keeping some cash on hand as an emergency cushion. Yeah?
Yeah, I know it's definitely case by case, but how much should I set aside?
Great question, yeah. What I typically tell people is go to your expenses and say, could I live on 6 months of expenses? Do I have enough in the bank to cover 6 months if I'm single, a single earner? If I'm a dual income household, then maybe you can get away with 3. Because the chances of both of you losing your job at the same time is a little bit less. But 3 to 6 is the benchmark for most folks. I also include deferred spending here. So if you're going to buy a house a year from now, are you going to put your entire down payment in the stock market? Probably not. Not a good idea, because the incremental return you might get over those 12 months is not as important as the safety of knowing that if we go off a cliff like 2008 style, you're not going to lose the ability to buy that home. So emergency cushion plus deferred spending, that 1 to 2 year short time frame. Next, we get to debt management. For every extra dollar that comes in, do I pay down debt or invest it elsewhere? And I thought Chris did a great job of talking about this as well. Here's an example. So who had the 6% student loans? Because that's the most common rate that I see. Probably everybody can raise a hand to that one. So, okay, if you have student debt, let's say you had like 100K at 6%. Shopping it out is one of those things that we're finding to be a pretty good option for people right now. So banks tend to try to woo clients in these ways, getting a relationship with a banker. I was even seeing, and I'm not affiliated with any of these, but for example, First Republic right now, I've had a number of clients refi their student debt going from 6% to 2.9%. So you cut that interest rate in half, you've freed up some extra cash to go to other things that you may need it for, right? So that's one of those, shopping out that student debt. That is something you can look at doing after you're done here. So make sure that you can look at SoFi, some of these other platforms. It's talked about much more now, but that's a really competitive, or a thing that can have a big impact on your planning. If you were to think about, let's say that we got rid of that 6% and we have kind of our minimum payment at 2% on my student debt, right? Should I be making extra payments to pay down that debt, or should I be prioritizing other things? Right? So think about that. I could choose to pay, like if there's a minimum payment of $500 a month on this, but I have some extra money, should I be putting more towards this or doing it elsewhere? Well, until I have my reserve, I think I should build up reserves. Once I have my reserves, I might want to start thinking about that magical compounding sheet that you guys had. So is it worth more to save 2% on the debt right now, or is it actually more advantageous to take those same dollars, the extra payments above and beyond the minimum, and put those towards a retirement account or other investments that would compound at a higher rate of return? Typically, it's going to be the latter, right? And especially, so those investments could earn better than 2%, especially in this case. Even if they don't in the short run, they're going to be compounding for 40 years or 50 years potentially. And so then you get your growth on growth stuff. So anyway, so that's just, I wanted to plant those seeds as real examples of what you may be thinking about coming out of grad school. Do I pay down the debt? Do I invest elsewhere? It's a bit more nuanced, but you got to think of a few different places where those dollars would go. Is that cool so far? All right.